Why one decision by the U.S. Federal Reserve can make stocks crash, house prices freeze, EMIs rise, gold rally, and even affect your salary. Imagine you wake up tomorrow, your home loan becomes more expensive, your stocks fall, your dream house suddenly becomes cheaper to buy, but somehow harder to afford. Gold rises, your currency weakens, petrol becomes expensive, and the strange part? Nothing happened in your country. One meeting, in a gray building in Washington, D.C., quietly changed everything. How? Stay till the end, because once you understand this invisible force, you will never watch financial news the same way again. Meet Sarah, 31 years old, software engineer. 3 months ago, she did something she was proud of. She bought her first apartment. She has a home loan, a small SIP investment she adds to every month, an emergency fund she's proud of, one credit card, a car loan she's almost finished paying off, a little gold her mother gave her, and a quiet dream, one day, a second property. She feels in control, like an adult who finally has her finances figured out. Then, one Wednesday morning, her phone buzzes, a news notification. The U.S. Federal Reserve has raised interest rates by 0.50%. Sarah reads it once, shrugs. So what? That's not even my country. She has no idea that sentence just quietly touched her loan, her stocks, her gold, her salary, and her dream house. This video is the story of how. To understand what just happened, forget economics for a second. Imagine money behaves like water. When interest rates are low, water flows everywhere. Into businesses, into homes, into stocks, into crypto, into new startups nobody has heard of yet. Everything feels alive. Everything grows. Now imagine someone somewhere slowly starts closing the main valve. The water doesn't disappear. It just slows down. Less flows to the far corners of the pipe network first. Businesses far from the valve feel it before the one standing right next to it. Economists have a fancy word for this. They call it liquidity. But you don't need the word yet. You just need the picture. A valve, a pipe, and someone very far away deciding how much water flows through it. And here's the twist almost nobody explains properly. The person holding that valve isn't in India, isn't in the UK, isn't in Australia. They sit in Washington, D.C., and when they turn that valve, the whole world's pipes feel it. Here's a question most people never ask. Why does one country's central bank affect the entire planet? Because the US dollar isn't just America's currency, it's the world's trading currency. Oil is priced in dollars. Global loans are priced in dollars. Even a company in India that has never sold a single product to the US often still borrows in dollars, or gets investment from dollar-holding funds. So when the Federal Reserve, the central bank of the United States, changes its interest rate, it isn't adjusting one tap, it's adjusting the main valve for the entire global pipe system. This is why professional investors don't obsessively watch 100 company earnings calls. They watch one meeting, 8 times a year, held by a group of people most of the world can't even name. Rich investors call this meeting the funk. You'll hear that term again. Remember it. Rewind to 2020. The world shut down. Businesses closed, people lost jobs overnight, panic everywhere. So central banks, starting with the Federal Reserve, did something dramatic. They cut interest rates close to zero, and then they did something even bigger. They started printing enormous amounts of money and pumping it directly into the financial system. Think of it like this. Imagine a city is flooding. Instead of fighting the flood, the government opens every gate and lets even more water in on purpose to keep businesses from drying up and dying. This flood of new money is what economists call quantitative easing. Strip away the big words and it simply means the central bank creates new money and uses it to buy financial assets, pushing cash out into the economy. That flood had to go somewhere. It went into stocks, into real estate, into crypto, into Sarah's SIP, even though she never noticed the connection. Her portfolio grew fast. She felt like a genius investor. She wasn't wrong to feel good, but she was wrong about why it was happening. It wasn't just her stock picks, it was the flood. But floods don't stay harmless forever. All that extra money chasing the same number of goods started pushing prices up. Groceries, fuel, rent, everything. This is inflation, and here's the analogy that makes it click. Imagine a classroom with 30 students and only 10 chocolates. Now imagine the teacher hands out extra pocket money to everyone, but keeps the chocolate count the same. What happens? Students start offering more money for the same chocolate. Prices rise. Not because chocolate became more valuable, but because there's simply more money chasing it.
By 2022, inflation in the US and most of the world had climbed to levels not seen in decades. The Federal Reserve had a problem. The flood that saved the economy in 2020 was now threatening to drown it in a different way. So they did the opposite of everything they did before. Starting in 2022, the Federal Reserve began raising interest rates aggressively, again and again, meeting after meeting. At the same time, they started doing the reverse of money printing. Instead of buying financial assets to pump money in, they let those assets mature and pulled money back out of the system. This is called quantitative tightening. Same idea as before, just in reverse. Instead of opening the valve, they're closing it and even sucking a little water back out of the pipes. Higher interest rates mean one simple thing. Borrowing money becomes more expensive everywhere. This is the moment we opened with. Now you understand the valve behind it. But Sarah still doesn't feel it yet. That's the strange part about this invisible force. It never announces itself directly. It arrives quietly, through side doors, weeks or months later. 3 months later, Sarah notices something odd. Her home loan EMI has quietly increased by 2,300 rupees. She blames inflation, rising costs, general bad luck. But that wasn't the real reason. Here's what actually happened. When interest rates rise in the US, it doesn't stay contained there. Central banks in other countries, including her own, often raise their rates too, partly to keep their currency from weakening, and partly because their own borrowing costs from global markets rise as well. Banks borrow money too. When it becomes more expensive for them to borrow, they pass that cost on to people like Sarah through higher loan interest rates. Her home loan is tied to a floating rate, which means it moves, quietly, invisibly, with decisions made thousands of kilometers away. She never voted on this, never agreed to it. It just happened to her. So that's why my EMI went up, she says quietly. A few weeks later, something worse happens. Sarah opens her investment app. Her portfolio is down 84,000 rupees. Nothing happened to her company. Nothing happened to her country's economy that week. So where did the money go? Here's the answer nobody tells beginners.
A pension fund in New York, managing retirement money for thousands of American teachers and firefighters, quietly decided to sell a portion of its Indian stock holdings. Sarah has never heard of this fund. We'll probably never hear of it again. Yet their decision reduced the value of her portfolio. Why would they sell? Because when U.S. interest rates rise, U.S. government bonds, considered one of the safest investments on earth, suddenly start paying more interest with almost no risk. Think of it like a shopping mall with two stores. One sells adventure gear, exciting but risky. The other sells safe, reliable jackets, boring but guaranteed to work every winter. When the safe jacket store suddenly starts giving huge discounts, people who were only buying adventure gear because nothing safe was appealing start walking over to the jacket store instead. That's what happens with global investors. When safe U.S. bonds pay well, some money moves out of riskier markets like India and back into the U.S. This is called foreign investor outflow, and it's one of the biggest hidden reasons your stock portfolio moves, even when your own country's economy hasn't changed at all. There's another consequence, and it's sneaky. When foreign money leaves a country and heads back to the US, something happens to the exchange rate. Fewer people want to hold the rupee. More people want dollars. Basic supply and demand. When fewer people want something, its value drops. The rupee weakens against the dollar. This is called currency depreciation. And because so much of what countries import, oil especially, is priced in dollars, a weaker rupee means those imports suddenly cost more. That's why petrol prices can rise, even when oil itself hasn't gotten more expensive globally. The rupee just buys less of it now. Sarah fills up her car that week, pays more than usual, mutters something about the government under her breath. She has no idea a pension fund in New York had anything to do with it. Here's the twist most beginners never expect. While stocks fall and currencies wobble, one asset often quietly rises during uncertain times. Gold. Gold doesn't pay interest. It doesn't grow a business. So when interest rates are low, gold can feel boring compared to stocks that promise big returns. But when markets get shaky, when nobody's fully sure where interest rates are heading next, investors run towards something that has held value for thousands of years, regardless of any central bank's decision. Sarah's small gold, the one her mother gave her, hasn't lost value like her stocks. If anything, it's crept up. She never thought of it as an investment, just sentimental jewelry. Turns out it was quietly doing a job the entire time. Not everything about rising rates is bad news. Here's the part nobody mentions on the news channels. When interest rates rise, banks also pay more interest on savings accounts and fixed deposits. For years, Sarah's emergency fund sat in a savings account earning almost nothing. Now, quietly, it's earning more. The same valve that raised her EMI and shook her stock portfolio is also rewarding the boring, safe money sitting untouched in her account. This is the moment Sarah starts to understand something important. Interest rates don't just make life easier or harder. They shift who wins and who loses. Borrowers versus savers. Risk takers versus the cautious. Stocks versus bonds. And the direction of that shift is decided in one room, in Washington, roughly 8 times a year. Sarah's dream, that second property, starts to look different too. As loans get more expensive, fewer people can afford to borrow for a home. Demand for property drops. In some markets, prices actually start falling or freezing because sellers can't find enough buyers willing to take on expensive loans. You'd think that's good news for Sarah, cheaper houses. But here's the catch nobody explains. Even though the house price is lower, her loan is now more expensive. So her actual monthly payment for that cheaper house might end up higher than it would have been on the expensive house a year ago, back when rates were low. The price tag went down, the real cost went up. This is the quiet trap that catches so many first-time buyers off guard.
There's one more character in this story, someone Sarah interacts with every single week without realizing the connection. The owner of the bakery near Sarah's apartment took a small business loan 2 years ago to expand. Back then, rates were low, and the loan felt manageable. Now her loan repayment has jumped. Her costs, flour, packaging, electricity, have risen too, thanks to the same inflation story from earlier. So she does what many small businesses quietly do. She delays hiring, cuts back on new equipment, raises prices slightly. Sarah pays a little more for her morning bread and never once connects it to a Federal Reserve meeting she never watched. This is the part almost nobody sees.
Interest rate decisions eventually touch jobs, small businesses, and everyday prices, not just stock charts and headlines. One evening, Sarah lays it all out. Her EMI rose, her portfolio dropped, her petrol got pricier, her gold held steady, her savings account finally paid something, her dream house got cheaper but harder to actually afford. Even her local bakery quietly raised its prices. 8 unrelated moments in her life, all flowing from one meeting in one building in Washington, D.C. Now it finally makes sense, she says quietly. This is why serious investors don't just watch their own portfolio. They watch the valve. Here's the honest truth. Sarah cannot control interest rates. Neither can you. Nobody outside a handful of officials controls that valve. But you can control how prepared you are when it turns. A few things Sarah starts doing differently. She keeps a stronger emergency fund, because rising rates can hit income and expenses at the same time. She avoids taking on unnecessary debt right when rates are already climbing. She keeps investing consistently, instead of stopping just because her portfolio turned red for a while. She resists the urge to panic sell during a downturn, because downturns tied to rate cycles tend to pass, historically, over time. She diversifies, some stocks, some gold, some safer instruments, so no single valve decision can sink everything at once. And most importantly, she pays attention to macroeconomics, the big picture forces like this one, instead of only watching her own portfolio in isolation. None of this makes her immune to the next rate decision, but it makes her ready for it. Somewhere in Washington, D.C., right now, a small group of people is preparing for their next meeting. Most of the world won't notice. Most people will go about their day, their EMIs, their portfolios, their petrol tanks, never realizing how closely tied they are to a room they've never seen. But you're not most people anymore. You now understand the valve. The people who build wealth aren't the ones who predict every interest rate decision. They're the ones who understand how the game changes before everyone else does.